A portfolio model can tell you expected return. It cannot tell you where to sleep, what to eat, or who to trust. That is the difference between normal investing and real-world resilience. Most investors think in models. Stocks return this much. Bonds hedge that risk. Gold performs during monetary stress. Bitcoin protects against debasement. Cash gives liquidity. Real estate gives income. And in normal times, this framework can be very useful. But the question Base 2 asks is different. What assets still matter when the model breaks? When liquidity disappears? When banks limit withdrawals? When markets close? When currencies fail? When supply chains stall? When insurance does not pay quickly? When borders become complicated? When the risk is not volatility, but access? That is a different world. In that world, an asset is not only valuable because someone else will buy it, it is valuable because it can do something. This is where asset classes become very different. Stocks are powerful in a functioning system. They represent ownership in productive companies, but they depend on markets, brokers, exchanges, settlement systems, legal enforcement, and functioning institutions. Gold is different. It is physical. It has survived for thousands of years as a store of value. But gold does not produce food. It does not generate shelter. It does not build community. It is a store of value, not a full life system. Bitcoin is powerful because it is portable and self-custodial if held correctly. It can cross borders in a way land cannot. But Bitcoin cannot shelter you. It cannot feed you. It cannot give you water. It is digital sovereignty, not physical sovereignty. Cash is useful because it is liquid, but liquidity depends on acceptance, purchasing power, banks, ATMs, payment systems, and trust. In many crises, cash is useful early, but if the crisis becomes monetary, cash can become fragile. Real estate is physical, but not all real estate is useful. A luxury apartment in a fragile city is not the same as productive land with water, food systems, and community. A rental property may produce income in normal times, but it still depends on tenants, law, utilities, financing, and local conditions. Useful land is different. Again, not all land. Bad land is not resilience. But useful land can become a base, shelter, food, water, hospitality, community, a retreat, a second jurisdictional option, a place to gather, a place to build, a place that still has function even when abstract systems become less reliable. This is why Base 2 cares about usefulness. The point is not that land beats every other asset in every scenario. It does not. In many normal market environments, stocks may outperform land. Bitcoin may outperform land. A business may outperform land. But the question is not only performance. The question is completeness. What does the asset allow you to do? Can you use it? Can you improve it? Can you host people on it? Can you produce food on it? Can it store water on it? Can it generate income? Can it provide a second base? Can it become a community? Can it still matter when the model breaks? That is the question. Modern portfolios are optimized for measurable risks, but some of the most important risks are not measurable in a clean way. Political risk, war risk, banking risk, supply chain risk, social trust risk, food system risk, jurisdictional risk. These do not always show up properly in a spreadsheet, and when they do show up, it may be too late. That is why useful real assets belong in the conversation, not as a replacement for every other asset, but as a missing layer. When models break, usefulness becomes a form of wealth. This is not a prediction, and it is not fear marketing. It is a stress test. Which assets still matter when the model breaks? That is the kind of question Base 2 studies inside the Telegram community.